Today I want to talk about the strategy that I use to max out my TFSA, RRSP, and FHSA accounts. I generally max out these accounts every year, and my strategy has evolved from a newbie investor to a more experienced one. And today I want to talk about all of it. All of the previous strategies that I used to use, the pros and cons, and what strategy I use today. So the strategies that I will be going through is an ordered list. And as we progress through this list, they become more advanced and are for experienced investors since they get more risky. So do your own research. Just because these tactics work for me doesn't necessarily mean that it would work for you. So the first strategy that we'll be going over is what I call the base case. This is where you save $2,000-$3,000 from a paycheck and then put that money in your high interest savings account. This could be something like EQ Bank. And the advantage here is that you yield some money on your cash. And as soon as the year rolls over, you pull that money out from your high interest savings account and put in $30,000 in your RRSP, $7,000 in a TFSA, and $8,000 in your FHSA. This is something that I used to do. I used to put in $2,000-$3,000 every paycheck in my high interest savings account. And then as soon as the year rolled over, I got new contribution rooms and I used to max out my registered accounts. And from there, as a self-proclaimed savings addict, I would start this process again. Anyways, where were we? The advantage here is that this is the lowest risk strategy. If the market falls by 20% tomorrow, you aren't panicking. You can still top off your registered accounts because the market really doesn't affect your high interest savings account because everything is in cash. On the other hand, the downside, especially for me as a long-term investor, I did not like the idea of cash sitting on the sidelines. If the market went up by 7%, I am losing all of that upside throughout the year since I have a significant amount of cash in my high interest savings account that is not in the market. In other words, I was FOMOing real hard, and the optimization that I was looking for was to see how can I continue to stay invested throughout the year. The next strategy that I used was instead of putting $2,000-$3,000 in my high interest savings account, I instead put that money in the market. My go-to fund here is VEQT. So every paycheck, I bought VEQT instead of putting that money in my high interest savings account. This way, I continue to become 100% invested in the market, which means that I ride all the ups and downs throughout the year. And when the year rolled over, I sold just enough shares of VEQT to top off all of my registered accounts. The advantage here is, like I said, you are always 100% invested in the market. And as a long-term investor, this is very beneficial. The disadvantage here, and this shouldn't be surprising to anybody, is that you are 100% invested in the market. If the market falls, you may not have enough capital to top off your registered accounts. This is a huge risk. But the way I think about this is that I am a long-term investor. I genuinely believe that the best time to buy VEQT is now. If at the beginning of the year, it doesn't bother me that the market might be down 50%. If that is the case, my non-registered account is big enough that instead of putting 50 shares of VEQT at the start of the year, I can afford to put 60 or 70 shares in my registered accounts to top them off. So in my eyes, if the market falls, it's a win for me because now I can put in more shares into my registered accounts. Another disadvantage is tax consequences. If the market performs very well and throughout that year you get a 10% return, if you sold $40,000 worth of XEQT to top off your RRSP, TFSA, and FHSA, this becomes a taxable event. So depending on your tax situation, you might get a higher tax bill at the end of the year. However, overall, you're still making more money than the first strategy of just putting that money in a high interest savings account. I think there's a famous saying that don't let the tax tail wag the investing dog. Just because you have a higher tax bill doesn't mean that this strategy is a bad one. However, when I was implementing this strategy, I was trying to think about how I can defer these taxes and squeeze more of that total return juice. And so this is where the next strategy comes. So in order to be more tax efficient, you should not sell any of your shares. And this is where borrowing from margin comes in. So the strategy here is that as the year rolls over, instead of selling your shares, you borrow against your shares and then top off your registered accounts with that money. The advantage here is that none of this is a taxable event. You don't need to sell $40,000, $50,000 worth of XEQT or VEQT at the beginning of the year, which reduces your tax bill by maybe 2 or 3K and allows your money to continue to compound. Also, depending on your portfolio value, you may not need to worry about market conditions. As long as your portfolio is large enough, you can borrow $40,000 from your margin account and top off your registered accounts. The disadvantage here is that taking margin is risky. You need to have a large enough portfolio size to not be margin called. If you get margin called, all of this strategy collapses. I made a full video on how I think about margin and the strategies that I use to make my margin account less risky. So check that video out. Another thing to remember is that this borrowed money is not free. You need to pay an interest rate with your broker to borrow this money. However, the interest rate that you're paying is significantly lower than the marginal tax rate that you might be paying. In my case, my marginal tax rate was 47%. However, the interest rate that Wealthsimple was charging me was around 4%. So this strategy made taxable sense for me. Another thing to remember is that as you contribute to your RRSP or an FHSA, the tax refund that you get has to go to the money that you borrowed. If instead you use that tax refund and buy a car instead or buy some fancy shoes, you have shot yourself in the foot, right? And this strategy is not for you since you're not disciplined enough. You should be taking that tax refund and first thing, pay down the debt that you took from yourself and set yourself in a good footing so that you can use the same strategy for the next year. This strategy works for me because I am in a high marginal tax rate situation and my brokerage gives me a reasonable 4% interest rate to borrow that money. And I'm disciplined enough that as soon as I get my tax refund, I pay down that margin debt. So yeah, this was my evolution of how I fund my registered accounts. However, do your own research because everybody's tax situation is different. I hope this video was useful for you. Let me know what strategies you guys use to top off your registered accounts, and I'll see you guys next time.